Okay, so for this morning, I want to talk about really what's going on in China. So, giving out the objective review of the problem, what's driving the problem, what's driving the sell-off, and of course, this recent struggle, right, represents a silver lining for the Chinese economy. So, a lot of people have been talking about it, and I just want to talk about what I have been sharing with my diligence community, and also sharing with you some of the key insights, some of the points which I'm about to make. So for those who have just joined Dividend Titan or have recently just chanced upon my blog, you've gotten onto my email list and you've been following me. So for myself, just to give a brief introduction, my name is Willie. I write Dividend Titan. I started since 2020. Now I left my banking job in 2018 after growing a bit tired and really burnt out from the financial industry. And in 2018, I realized that I was burnt out. At the same time, I felt that I was financially secure at a point in time. So I quit my job back then to pursue investing full time. And since then, I've been writing on my blog. I've been traveling across to different countries to do investigative research, to do investigative reports on what's going on in the markets. So one of the most recent highlight was my Hong Kong trip earlier in August. So I have met fund managers, brokers, friends, acquaintances, even lawyers as well, to try to understand what is going on the ground. For me, I personally invest in the Hong Kong stock market. So a disclaimer, I do own positions in Hong Kong stocks. So whatever I say here, you just have to understand, I'm coming from a point of an investor, right? So for me, I've been talking about the markets over the last 13 years. I've been investing, for more than a decade now. And sometimes I've been on radio, I've been on conferences, sharing some of the tips and tricks on how to get started investing. Also sharing some of my ideas, profitable ideas, which I like to share, across the different markets. I personally invest in Singapore, Hong Kong, and US. For today, I want to be talking about China. So that's where the focus is, because I do see an opportunity in this market right now. There are a lot of businesses, a lot of companies which are offering very good value in this heavily discounted market. So this is something which I want to talk about, and I'm just going to spend the next an hour and a half talking about it. Also, sharing about what my community has also been doing as well. I know you might be worried about what's going on, because after reading about the bad news, the headlines about China, you can see the recent sell-off. In fact, the sell-off has started, since COVID itself. You have the CSI 300 composite, which was down. You have the Hang Seng Chinese enterprises, which was down as well. And really the reason why for this sell-off is really because of a couple of things. Number one, you have the negative headlines which are coming out from most financial media. You can see from the Wall Street Journal titled "China's 40-year boom is over, what comes next?" And you can talk about how the economy is facing signs of distress. You're talking about how China's hidden debt has gone over to $8 trillion. And really this was driven by weak land sales from property developers, from the government itself. We have seen billions of dollars, hundreds of billions of dollars being wiped out from the Chinese property market. And as a result, you have global funds selling off Chinese stocks as well. So this sell-off is really driven by the global institutional funds, which are pressured by their clients, in the US, in Europe, in developed countries, telling all these institutional funds to sell off. The interesting thing here is that while all these global funds are pressured by their clients, for myself as an individual investor, I don't have any clients which pressure me to sell. So in this case, what really matters most is whether I can find all this value and holding it for the long term. Right. And of course, you also have China developers, shares dropping the most since China Evergrande Group announced that they have some issues trying to restructure their debt. You have Country Garden also potentially defaulting on their bonds, and you have a couple of other developers as well, which are facing some issues. So what I can agree on here is China do have real economic challenges. I mean, the country, there's no denying that the 1.4 billion populous economy is facing some deep challenges. And this is something which I want to bring forth as an analyst, as an investor. I do see some of these potential challenges. But again, China is just like any other big countries. China is the second largest economy today. You have other countries also facing similar issues. For example, in the US, you have interest rates going up. You have the economy facing inflationary pressure, and at the same time, you have US commercial properties also facing real trouble as well. So each country has its own issues. Today, China do have its real economic challenges, and if you think about it, all these real economic challenges, some of these problems, is what is really driving the market sell-off today, which we are seeing right now. So this is what we can agree on. However, if you look closely into the detail here, despite all this doom and gloom, the economic data has shown that there are actually signs of life, signs of recovery. So most of the weak economic data which we have seen coming out from news outlets, from the media, most of this data has been priced in. So what do I mean by priced in is that the market right now, where the shares are trading, where the prices are trading, sort of reflects the soft economic data which we are seeing. Talking about inflation, talking about the PMI, you're talking about the economic growth as well. So there are economists, there are journalists talking about how this downturn could be affecting the economy, but there are also people saying that China may not be in a crisis, even though it is still trying to struggle out of what's really going on. So this is where the opportunities come, because as an investor, if you want to excel in investing, if you want to be good at investing, there are really three things we can do here. We either be the first, or we be the smartest, or we be the most patient. And I find that sometimes as investors, we cannot control one and two, because to be the first, you need to have insiders information. You need to have the leading information. This usually comes from global institutions, big institutions, sovereign wealth funds, hedge funds. All these guys, when I talk to them, they do have information which we might not be readily or publicly disclosed to retail investors like ourselves. So it's very difficult to actually control that situation unless you are inside the industry. Or you can be the smartest, right? You can have hedge funds leading a team of research analysts to help you crunch the numbers, to help you find out on the ground what's going on, right? You have all the intellectual firepower to help you. But sometimes, again, we might not have that kind of fortune, right? We might not have that capability. So at the end of the day, we have to actually find the sweet spot where we reasonably think, as human beings, where we invest, sometimes what we need to be is the most patient. And especially when it comes to investing in China, patience is key, because while a lot of global funds, they are selling off, and we can really understand that, because when you are an investor, a foreign investor investing, say, in an emerging market in Asia, which is far away from your country, sometimes you don't really know what's going on. And when they smell the slightest signs of trouble, the first thing they will do is they will sell, right? And they will sell, and capital will flow back to their home country. And it makes sense, because as the US economy, as Western developed countries are raising interest rates, it does make sense to actually deploy their capital out of Asia and into their own home country because of the high rate of returns from high interest rates, right? So it doesn't really have got to do, the sell-off in some sense hasn't really got to do with fundamental issues. Sometimes it could just be due to fear, pessimism. And as investors, this is where we can really capitalize on. So what's important here as an investor, and this is something which I always share with readers, with my members as well, it takes some discipline and it takes patience. And I think that this is the most reasonable set of skills which we can have in order to outperform our competition, for example, the institutional players, right? So there are three big problems which I want to identify today, this morning, with regards to China, and what my thoughts are, and whether some of these things are really true as what the media says. So the first thing which I want to really address is the elephant in the room, which is China real estate. So the big problem with China real estate here, and again, a lot of research analysts whom I talk to, they don't like China real estate, right? There are surveys based on conversations, based on what you have read. A lot of analysts, they don't really like it. Number one, because there are a lot of uncertainties. They do not know how to make known some of this information which they have read and crunch it into their into a database, into their Excel spreadsheet. After all, a lot of these analysts which works for banks, works for financial institutions, they rely on hard figures, hard numbers, which allows them to do some forecasting. The reason why I know this is because I was from the banking industry and I had to deal with a lot of this number crunching previously. So it is, sometimes they have to rely on all this. But as investors, we don't need to follow very closely on financial models, financial modeling, right? What we need to understand is to use a bit of logic, a bit of common sense, to try to understand, to try to match what we read in the media, compare it to what's really on the ground. So the problem with China real estate is that over the last 30 years, China has been growing at a very fast pace, right? It has grown in double-digit growth every single year, right? And really because since the 1980s, the economy has opened up. It has lifted millions, hundreds of millions of people out of poverty. And the government had one big concern. It need to find housing for many of these, for its people. So what it did was it adopted what it called, or what is commonly known now as the pre-sales housing model. What this means is that as long as home buyers, they plan to actually buy a house, they plan to actually upgrade to homes, all they need to do is to pay upfront the amount of cash which they have. Remember this, that China has a huge savings rate. So unlike the US, where a lot of them, they are in debt, in China, savings rate is huge because it is in the Asian culture to save, right? And this pre-sales model really capitalizes on the buyer's savings. What this means is that every time when a property developer wants to develop a property, they can straight away take the entire amount, the cash upfront, to develop the property. So this amount of cash upfront which the developers have, they can use it immediately to bid for new land again and start developing new projects before the existing projects are completed. So this accelerates the growth of the supply of housing, because back then there was very little supply in homes, in apartments, and the government need to figure a way out how to get all these private developers to start building a lot of all these apartments. So in 2021, more than 90% of residential properties in China were pre-sales. And it accelerated the growth of properties and led to that double-digit growth in the Chinese economy. So as long as developers continue to borrow debt from banks, from the government, from the local government as well, they can sell the homes, they can sell houses very quickly to buyers. And this sort of creates excess supply in the market, and which is what we are really seeing right now and what the media is reporting. So the result is that the developers are growing too fast. And as a result, China is trying to cut lending to developers. And that's what we have been seeing over the last few years, because this pre-sales model has sort of started to lose its effect. In other words, China doesn't really need this pre-sales model anymore because it has already provided a lot of houses, apartments to its people. So what it needs to do now is to actually slow down this process. And it's forcing these developers to slow down this process, right? Because it can get very addictive to do this pre-sales model. It gets very profitable for developers to do this pre-sales model. And it is important to understand this concept because when this pre-sales model is very addictive, it's like developers going on drugs, right? They can borrow very quickly, they can develop the projects, they can take on the full upfront payment from the buyers, develop the properties, and before it gets completed, they can take all this cash, they can bid for new land and repeat the cycle itself. So it gets really, really fast, right? And as a result, you will see that China is trying to curb the lending to developers. As a result, also, because of this restriction of lending to developers, we see a lot of projects being uncompleted. And because projects are being uncompleted, the developers are not able to refinance their borrowings, they're not able to refinance their debt. Projects, property development projects came to a complete halt, and that left a lot of buyers angry. So if you've read on the recent news over the last couple of months, you'll see mortgages, buyers still continuing to pay their home mortgages, but they're not really seeing the apartments or their houses getting complete. That's because the developers, they had no choice but to stop the projects. And that's what the Chinese government is really trying to do, right? And that's the situation right now. And from the Western lens or Western point of view, you would see that this is actually quite a scary situation because in China, 70% of the household wealth is actually held in properties, right? You can see on the gray bar right to the left, which is very different from the US. In the US, only 24% of your total household wealth is contributed by properties. The rest is in the stock market, in unit trust, which is mutual funds in the US. So it's a very different dynamic here. So when you put on a Western lens or Western point of view, you will come to realize that, hey, it's actually very scary if the whole property market crash. On the other hand, you will also realize that a lot of this household wealth in China, which is backed by properties, is actually backed by the cash savings which the people has. So it's very different. The risk comes not in the population, in the Chinese population themselves, but the risk in China is really coming from the over-leveraged property developers. And that's what the government is trying to control these days. In the US, it's very different. The US is the direct opposite, right? The risk comes from the people. That's why you have the subprime mortgage, the global financial crisis, which has really caused a huge disaster to the US economy back then. And China knows that it cannot afford a huge or major global financial crisis like this. That's why before things start to get worse, it is actually controlling, it is reining in some of this, the situation right now by imposing very strict measures. For example, trying to limit the amount of financing which the developers can make. Also trying to increase the amount of down payment which the buyers have to make before they actually buy a property project, right? So in China, there's no short of cash from the buyers. Buyers are ready to actually put in the cash. It is the problem really lies with the developers, and that's what they're really trying to do. They're trying to remove or trying to move away from what you call the pre-sales property model, right? And this is very important because this really sets the tone of how the economy is. So China is actually going through a structural shift in this pre-sales model. They are testing out different models. For example, the percentage of completion method is one of the models which they're trying to adopt. This is something which we have been using in Singapore by the developers. The percentage of completion method simply means that every time, let's say if you buy a new launch in Singapore, you don't need to pay the full amount to the property developers, right? Like your CapitaLand or your CDL. You pay as the project gets completed over time. So you pay bit by bit. So the bank will sort of help you to finance this piece of mortgage by paying in proportion to the developers. So it's a much safer way. The developers won't have the full cash injection upfront. So this really leaves them to be more prudent in terms of their cash management cycles. You can see that China is really doing away with the pre-sales model. In fact, it is testing new property models in some of its cities. For example, Xiong'an is one of them. And this particular property sector in this particular flagship city has also faced some issues as well. And they are right now trying to shift away from the pre-sales model to other models as well. So China is really doing a lot of major changes to its economy. And as a result, it is normal to see how its GDP growth has actually started to come down, because before this huge property debt came down, a lot of the economic growth is driven by property. In fact, close to 1/3 of China's GDP accounts for property. At least 1/4 of its growth is really coming from property development, property projects, right? Construction. So this is something which China is actually trying to curb. But you can see that despite this slowing down in its economy, China is still targeting a modest growth, right, of roughly about 5%. And this really falls in line with other big or major economies. For example, in the US as well, in the UK. So China being the second largest economy, it is actually normal to see how this growth has started to normalize. And you can see that for many of these economies, right, even though that they move into a single-digit growth, they are still doing very well on the ground, right? From a bottom-up approach, you will see later on, right, when I share with you, a lot of companies, a lot of businesses, they are still doing very well, right? It's just that economists, analysts, they have fall short of expectation because the mindset for the Chinese economy hasn't exactly changed. Many people are still thinking that China has to actually grow at a double-digit rate, but this is something which we will most likely not see in the future. China is most probably going to see a single-digit growth rate going forward. And this is a very crucial piece to the puzzle, because once we get the expectation right, we are able to actually better understand, what sort of things, the reality it is going on the ground. And sometimes there is a difference in what we are reading and also the reality with some of these companies. For example, you see baker.com. This is an online property transaction service in China. It's basically an online portal in China, one of the largest in China in doing property transactions online. Right, so they track property transactions, they track property volume across China, across all the different cities. And it was very interesting because in the first quarter of 2023, they recently spoke about some of the implementations of real estate policies in China. And one thing which I actually found out, because as an analyst, when I'm looking at some of these businesses, I tend to take notice of some of the transcripts because that better allow me to understand what is the reality on the ground. You will realize that what they actually say in this green box here, I'll just read out to you. Since the Politburo meeting, we have observed that in Beijing and Shanghai, the number of home tours, new customer demand, and transaction volume are the first to pick up. The potential rollout of improvement demand-related policies is expected to activate more than half of the population in the demand structure. So what this really means is that what Baker.com is seeing right now is that there's actually a change in the stance towards the real estate policy or the property policies. China is in fact trying to loosen up some of the property measures, and they are already seeing transaction volume, they are seeing customer demand to actually pick up. But definitely, it's not something where it's an immediate rush, right? It just takes time for some of this transaction volume to pick up. And you can see for the first quarter 2023, if you go to this company's website, if you go to this company's latest financial results, you can see how its results has actually fared quite well this year. So while the media is slow to pick up some of these little nuances, companies immediately are already picking up some of this useful data, right? So the key thing here, right, is you can see that all this, what's going on in the real estate troubles, right? You're talking about sell-off by developer shares, talking about developers going to default, into bankrupt, but that's only one piece of the puzzle. And more often than not, when we're looking at opportunities, whether in the stock market, they are to be found during times of maximum fear. And the maximum fear here, it really comes from the property sector, because you are seeing developer shares being sold off, you are seeing developers going to a default, they're not able to pay their loans. On the other hand, you are also seeing many home buyers on the sidelines, ready to put in money to invest. Now, what's interesting is because when I was in Hong Kong and many of the people whom I talked to, they shared with me one thing very much in common is if you're looking at the mainland Chinese, going forward, the trend is such that because most of their wealth is tied up in properties, and most of their wealth is tied up in properties, usually they tend to actually buy. It is very common for them to actually own 2 apartments, right? One in their own home city, which is where their parents reside, and one is in the new city which they are moving into for work, or for their career. So typically, each individual may have actually 2 or even more properties, right? And what's interesting is that I realized that many of the Chinese, when they buy properties, they don't buy to rent out. They buy it as a store of value. And in fact, if you rent out, right, sometimes when you rent your properties out, you might think that they might say that, hey, are you in financial trouble? Why do you need to rent out your property? Because they know that over the long term, property value in China would gradually increase, a lot like Hong Kong. Of course, bearing the fact that you have to actually pick the right properties in the cities. It's the same as property investing in Singapore, right? You can't just buy any private development or property projects and make good money. There are some places where your ROI on certain property projects are not as good, right? So at the end of the day, it boils down to property selection as well. So it's the same thing for China. In the long run, properties, the people in China are confident that property value will continue to go up. And this is something which is really ingrained in us as Asians. And again, right, opportunities are found in times of maximum fear. If you think about it, I'm going to give you one example. Right? If you see, right, before all this sell-off in the market, you realize that actually there was one period of time where Hong Kong's Hang Seng Index was actually trading at one of the lowest points in 2015. So if you actually Google, if you actually check out the Hang Seng Index chart, it actually fell to its lowest in 2015 because, again, of bad Chinese sentiments, global expected rise in interest rates. People were scared about the total social financing issue, which is the shadow banking issue in China back in 2015. And that caused a major sell-off in the Hong Kong market as well. And 2015 was one of the darkest periods in Hong Kong. Now, what's interesting, then after, right, 2015, it started to recover all of a sudden. There was this slight change in sentiments where the rise in the Hang Seng Index after 2015 really came from people from China and other overseas investors. And it had a good bull run from end of 2015, 2016, 2017, and 2018. So a good 2 to 3 years run. And during that period, there were a lot of very interesting names which have started to actually soar. So this is something which you might want to pay attention to, especially when you're investing in China, when you're investing in Hong Kong. When you are looking at some of the worst times, the worst possible times, is actually one of the best times to actually look and put our money in. And really, that's the not so secret to investing here. As a long-term contrarian investor, we want to be looking for opportunities where people are really selling off. And again, right, it boils down to being patient about it, right? So this is the first issue which I like to address, which is the property market in China. I don't think that it will cause China to collapse. It might actually moderate China's economic growth. But the key thing here is that a lot of real estate policies, have already started to turn the sentiments. There is actually a divergence in property policy, which is actually trying to aid the property sector, right? So having said that, right, property developers is probably not something I would consider, because there is a structural issue in property developers in China. But what I would consider are stocks or sectors, the businesses which have been affected, just by the sell-off. And that's where it gets interesting here, right? Now, the second thing which I want to address this morning is China's consumption and youth unemployment, right? So sometime back, we have heard about how the Chinese population are looking to actually lay flat, how the young is, trying to what they call Tang Ping. And they also resulted in a surge in youth employment. And then a lot of the media also talks about how this could actually affect China's economic growth. Now, the question is this really going to kill China? I mean, if you think about the concept of this narrative here, right, does it really make sense to see, right? Because if you go to China, I have friends, I have acquaintances who have just came back from Zhuhai, from Beijing, from Tianjin. They all tell me a very, very different story. And you can see that this very same story can also be found in businesses, in companies. For example, if you see for Alibaba, right, I'm going to take Alibaba as an example. And the reason why is because Alibaba is a very close proxy of China's consumption spending or consumption sector. China's gross merchandise value, or the online spending in China, has reached trillions of dollars, right? In fact, it's roughly about, let me just check my numbers, it's roughly about 13 trillion yuan, right? And Alibaba takes up about more than 60% of China's online spending, right, which is your gross merchandise value. And you can see that Alibaba is sort of a proxy. When you're looking at China consumption spending, it's good to pay attention to what these businesses or these companies are doing. If the company is not doing well, if they're talking about a lack of spending, if their revenues are dropping as a whole, right, then you'll realize that there is some structural issue. But if you see Alibaba, it has over 1 billion active users in China, and another 300 million global users outside of China. So you can say that Alibaba dominates the online spending sector, the online e-commerce business. And if you see for China, right, it has grown very aggressively in online shopping since 2015. 2015, it grew its gross merchandise value from 3.9 trillion yuan all the way to 13.8 trillion yuan last year. So if you're talking about youth unemployment surging, then it doesn't make sense to see some of these numbers growing. In fact, if the middle income group or the youth is not spending, or if they don't have enough money to spend, then why is it that the online shopping here continues to grow year after year? And if you see for Alibaba's recent results, they recently released their latest quarter, which ended in June. You realize that they have actually changed. There's actually some improvement from what we have read and what I've shared in my community last year or the year before. That there's actually a change in sentiments, and I did tell my community that a lot of this revenues and profits will eventually recover, and this is what we are seeing right now. Its latest financial quarter, which has ended June this year, you can see that the total Taobao and Tmall group has grown by 12%. So this is driven by its local commercial online e-commerce business. It has grown about 12%. Yeah, we'll scoop a tick here. And then you can see the international business group that basically sells, where Alibaba sell their products overseas from China to all across the world. It has grown about 41%. So you can see how this is actually driving the economy, not just domestically, but also the global economy. And this big drive in its international digital commerce group is also driven by the fact that the global economy has reopened from the COVID pandemic crisis. And that's why you can see the exports have been flourishing from China to overseas. The domestic spending, you can see here how Taobao and Tmall Group have also grown by 12%. Right? If the economy is not doing well, we probably wouldn't see some of these very healthy numbers which is going on, especially when you're talking about a company which dominates most of the e-commerce spending. So it's not just Alibaba which we are looking at. Even for other internet companies like JD.com, you can see how its revenues have been actually growing. In fact, you can see its latest second quarter 2023 figures, net revenues has grown by 8%, and also reflects how the positive sentiments is really going on in China. So it is important to take a note or take a look at some of these little nuances when we try to understand what's really going on the ground. So, and one more thing, right? And to be prepared for this, right? You might want to be prepared for this, is that a lot of global players are still aggressively trying to enter the Chinese market. Despite the US-China chip wars, the geopolitical tensions, very interestingly, a lot of companies, they are quietly entering and growing and expanding in China. They're talking about LVMH, MS, Apple, Intel, and other many consumer-related companies have right now about between 10 to 25% of their revenues from China. Apple, which is one of the most valuable tech companies, consumer electronic companies, have more than 20% of its revenues coming from China. Even Intel as well, which does your consumer electronics, LVMH is about 20% of its revenues coming from China too. So it's very difficult to say, okay, it's hard to ignore the problems in China, because these global companies, these global players, they are definitely much smarter than many of us individual investors. And if they had listened to the media, if they had listened to what's going on with the news, then why are they not pulling out of China and instead pouring more money, pouring more capital into the economy itself, right? So again, right, when we put on our analyst thinking caps, we want to understand this point when whatever we read might not reflect the true reality of the situation. We have to again look into the numbers. We have to look into the data and see where the trend is going. I'm pretty sure some of you guys in today's webinar have probably Tesla shares, and you'll realize that actually Tesla, most of its growth will be coming from China as well, right? You can see right now the Chinese market contributes 1/3 of Tesla sales. And in fact, in the previous quarter, in the first quarter, so this was published earlier this year, the Chinese market has accounted 1/5 of its revenue for Tesla in the first quarter, right? So Tesla has its eyes set in China. And there's a reason why it's competing very aggressively in the electric vehicle market for China, because China will be and is the largest electric vehicle market in the future, right? In terms of electric vehicle production, in terms of battery production as well. It's hard to ignore the Chinese market. So as much as a lot of the super investors, the fund managers, the politicians are just beating down hard on China, try to look at what's underneath the hood and what these guys, where they're putting their money in. Another example which I like to give, and this is one which I have recently shared in my diligence research report, which was published this week. I spoke about Starbucks. So for members who have recently opened up my report, you actually see Starbucks, and again it reported very strong sales figures, revenue figures for its latest third quarter fiscal 2023. And I like to point out, you can see how while global comparable store sales increased 10%, it's North America and US comparable store sales increased about 7%. What's interesting to note here is China comparable store sales increased by 46%. So what this means is that China has right now about 6,500 stores. Starbucks has about 6,500 stores in China. This very same 6,500 stores, so you don't include the new store openings, right? These 6,500 stores have increased its sales. The revenues coming from these stores have increased 46%. Again, right? Starbucks sells upmarket, slightly more expensive coffee. And in China, where it's a predominant tea drinking culture, just like Russia, the coffee per capita for coffee consumption has actually continued to increase year over year, and it has increased very actively. So the change in consumer behavior in China is also, being influenced by some of these consumer goods which is coming in. The way the middle income thinks about trying to have better living conditions, standard of living, they are being open to many of these new products, new services. And you can see that all these businesses, especially like Starbucks, for example, they have continued to grow their presence in China. In fact, US and China alone comprises now about 61% of the company's global portfolio. So alone, right, Starbucks can just focus on US and China to really grow their business. Right, US roughly about 16,000, but China is not far behind, right? They have about 6,500. And Starbucks did mention that their plan is to grow from the current 6,000 plus stores to 10,000 to 20,000 over stores in the foreseeable future. Very interestingly, when I was reading about Starbucks earnings call, so during the transcript, after management shares about their latest results, there will always be analysts who are sitting in the call asking very tough questions, very pointed questions as well. And this was one of the analysts from TD Cowen, and he did mention about what's China's current macro situation. So you can see in this red box which I highlighted, he did ask about the volatile China macro, how would it affect Starbucks, and whether there's actually any room for actually improvement here, right? Because they are thinking that China's macro is actually becoming a little bit more uncertain, right? Just like how they're thinking, the West is also thinking, from their far away place, they are trying to figure out whether China is actually recovering, whether there's any signs of improvement. And this was very interestingly, this was what the management has said. In China, Starbucks is seeing very healthy margins. At the same time, right, they are also talking about solid profit margin expansion, and they're expecting to actually deliver 50 to 20% earnings growth, which they're actually seeing here, right? So for Starbucks, right, on one hand, you might ask yourself, can we actually take management's word for it? Sometimes they can just plug in some numbers. But if you see for Starbucks, if you look at how the numbers have been, right, they have been generating a lot of free cash flow. They have been growing very reasonably. And at the same time, they have very steady profit margin. So it has already been around in China for quite a substantial bit of time. Starbucks has been a very reputable brand as well, right? So you can see that many of these companies, businesses, which are far expanding into Asia, into China, are really seeing some big improvements. So when we talk about consumption, when we talk about youth and unemployment surging, when we talk about consumption spending is weak, then why are global companies such as Starbucks, such as Apple, such as Intel, such as Tesla, are still expanding in China despite all this bad news? Right? So this is something which we have to actually really understand. And over the next 60 days, I just want to try to get you to understand that it will be a very critical point, to try to understand over the next 60 days, because from all this bad news revolving around China, there's one last important thing which I want to talk about, right? So we've talked about the property sector, we've talked about consumption spending. The last thing which I want to talk about is the Chinese easing policy, because there has been a wide divergence in the monetary policy support coming from the People's Bank of China, the PBOC, and this will heavily affect how China's stock market will be trading over the next 2 months, over the next quarter or so. So it is very critical here, and this is something which you need to understand for this particular webinar, right? So China still has plenty of room for monetary easing. The last time it did a heavy stimulus measure was back in 2008, 2009, during the global financial crisis, where it lifted global economies out of the crisis itself by doing very heavy monetary policy easing. So they basically printed a lot of money. They injected a lot of liquidity in the system. So liquidity meaning a lot of cash into the system in order to prop up or support not just China's economy, but also global economies all over the world. But that monetary easing policy has actually came down since then. So over the last 15 years, 10 plus years or so, China's monetary easing has sort of slowed down. But you can see that in recent years, after the property debt came down, after China has conducted its tech regulations, it is trying to spur up monetary easing again. So every time, right, when we are looking at stock markets, when we are looking at valuations, when we are looking at businesses, one thing to note, right, is when economies or countries start to conduct easing policies, when the central bank starts to ease their liquidity, that means providing essentially more cash, is actually kickstarting the next valuation run for many of these businesses, for these companies. It's the same for US. If you look at the US, after 2009 global financial crisis, the US started its quantitative easing, right? It did not only just 1, 2, or 3, it had 4 quantitative easing over the last 15 years. And that has really caused a very strong bull rally in the US stock market. China will be the same thing as well. It has plenty of room for easing. It is going to start its stimulus measure in order to support its general economy. And we are really seeing this happening, right? Since 2019, since 2018, 2019, it has gradually started to ease, conducted easing policies by lowering interest rates. But it's only in the recent years where it really clamped down hard on the property sector that it has aggressively increased its monetary easing. So you can see while the rest of the world are increasing interest rates, China is actually going in the opposite direction by actually easing its monetary policy supply. So you can see that we are actually in an inflection point today where you are looking at the Federal Reserve versus the People's Bank of China. It is crucial to understand that there is actually policy divergence today. China versus the rest of the world is basically forming this massive opportunity that it could actually play out in the coming months. In fact, come playing out next year, 2024, assuming or barring another crisis event, right? So we are really at the start of a bottoming out and a recovery. It's just a matter of time. Again, right? It really calls for investors to be patient when we are looking at some of these. So monetary conditions, as I've mentioned, as investors, it's important to understand the direction of central banks trying to face monetary conditions. In the US, you are seeing high interest rates, which means that the money supply is actually slowing down. The growth of money supply actually went into negative territory. This is something which I actually shared in my market outlook with my community members earlier this year, how US is actually tightening its screws in terms of its liquidity, and that's why you're seeing a lot of volatility. You are seeing a lot of pressure coming in the stock market. Now, on the other hand, you are looking at China again, easing their policy. So monetary conditions will have serious implications on how global investors, institutional investors are going to put their capital. So this is actually important. Capital will be attracted to places or sectors and economies where there's actually an ease of liquidity. Okay, so we don't want to fight the Fed, we don't want to fight the PBOC. We want to see where the trend or the capital flow is going, and we want to actually be in line riding in the tailwind of those capital flows here. So
Okay.
on one
And
hand, you
yeah,
have the US
then
tightening
yes, 你要做哪一种
with high interest
因
rates.
为现在你的那
Global
个
developed
batch holder 已经
markets are,
要是看美元一样，
are flowing US interest rates. They are tightening, increasing interest rates. This could actually lead
不是要做那个
to Asian currencies or Asian markets having that kind of volatility. So we are seeing in other parts of Asia, Southeast Asia, we are actually seeing a weakening, for example, in Asian currencies, as capital are actually flowing from Asia into the US. And it really makes sense, right? Because if you're talking about capital flow, money will obviously flow to the place where there's actually higher interest rates, because that's where you typically get to see a higher rate of return, right? So that's why we are seeing a lot of all this volatility here. As a result, when we are looking at some of these capital flows, we want to be positioned in ourselves where there is a flush of liquidity to actually support the economy. So while Asian markets, you are seeing that they are also trying to raise interest rates, China is one of the few Asian countries where they are lowering interest rates. Right? So you can see this divergence in policy. We are looking at an inflection point here in today's financial markets. So these 3 points, right? This situation, these problems here. We are talking about property, we are talking about consumption spending, we are talking about China's easing policy having a big effect on the markets. It's important to take note about where we stand in terms of the stock market valuations. If we see that the price to book has hit one of the lowest for China shares in Hong Kong, that's why I am actually putting my money and deploying capital in this part of the world. You can see it's actually one of the lowest. Again, right, you can see how the charts has validated the point that there is good value in some of these very, very cheap markets here. China's low valuations today sort of reflect this very soft economic reality, right? When everyone is just pessimistic, very fearful, it's normal for China to be trading at such low valuations. However, when we are looking at when the economy starts to pick up, this valuation recovery will be very quick. It will be very swift, right? It's just like a spring ready to actually make that bounce. So the moment the market picks up very improvements in the data, in economic data, when they pick up improvements in China's recovery progress, what's going to happen is that this valuation recovery across China's market, including Hong Kong, will start to see a sharp rebound, right? It could, go up from anywhere between 10 to 20% in terms of the increase in the recovery. So valuations have been beaten down to one of the lowest levels today. And what I think is that the markets currently has been priced in, which means that low valuations are already reflected, have already reflected reality on the ground. So any signs of an improvement here, right? Whether it is economic data, whether there's improvement in property developers restructuring, whether there's improvements in the property sector, whether there has been more monetary stimulus, we will probably see a rebound in a very meaningful way. Just like how I mentioned in 2015, the Hang Seng Index saw a quick rebound. And you can see in 2018, right, as I shared earlier, how capital started to flow back again into the Chinese economy. So we might see a very meaningful potential jump in the markets here today. One very interesting point, other than looking at Alibaba earlier, if you see for the Chinese banks, which are also a proxy to the Chinese economy, into China's financial markets, you can see that they are also trading at one of its historical low. ICBC, which is the largest bank in China, which is also the largest bank across the world by total assets, is now trading at a heavy discount in terms of its price to book ratio. So again, right, when you talk about Chinese banks, it does reflect the doom and gloom of the economy today. And what we are seeing right now, the valuation is just so low that if you're looking at bargain opportunities, sometimes you don't really have to look too far or too deep into the market. You are looking at blue chips which are offering good valuations, in building your portfolio. And this is really more than enough, whether you're building an income-based portfolio for dividends or whether you're building a growth portfolio. This really strikes us as a very interesting time which we are living in. So the trend, right, which we are actually seeing today on the ground is there are fewer and fewer investors which are buying into the Chinese economy. Right, you can see that global investors, global institutional investors, they are already selling out of the market. When I was in Hong Kong, fund managers whom I talk to, they do all tell me the same thing, right? That a lot of global institutional funds, big funds, they are exiting the market, they're selling away their Chinese stocks, and really because they are being pressured by their own clients overseas to sell all these stocks. So they have no choice but to make redemptions. That's why you see a spiraling effect or sell down in the Chinese stock market. So that's a big difference again, between individual investors and institutional investors, because we are not beholden by clients telling us to sell, right? As retail investors, as individual investors, we have the full control, the full discretion to choose when to buy and when to sell. So it makes sense that we might not have, we might not be the first to see new information, or we may not be the smartest investors in the room compared to some of the big boys here. But what we do have, which all these institutional investors do not have, is that we have patience to hold on to what is interesting in the markets right now. So fund managers are being pressured to sell, being pressured from clients to sell. And as interest rates go up, it just makes sense that foreign investors do prefer to see a higher rate of return, to get higher rate of returns from their own home country, because as interest rates go up, in the US, in Europe, the question they will ask themselves is why you want to invest in, for example, China, right? They might as well just invest back in their home country. But as Asian investors, as local investors here, this is our home bias, this is our own home country. So why not invest in this home market here? So this is one of the key things which I want to share with you. And another thing which was very interesting, which I also got earlier when I had my investigative trip in Hong Kong, is that you will realize that a lot of the Chinese recovery is meaningfully trickling down to its peripheral cities. For example, Hong Kong is seeing tourist arrivals increase significantly, even though it has yet to hit the pre-pandemic levels. But you can see that there's already a sharp rebound in terms of tourist arrivals, which means that earlier this year, a lot of the Chinese visa hasn't really been approved, right? The Chinese government is still withholding the applications or the approvals of Chinese visas. But later this year, in the second half of this year, what I've actually heard is that the Chinese government has already relaxed the applications of visas. So it's actually much easier to apply for visas or permits to travel out of the country. That's why you see for this week, the travel week or the Golden Week has been so far, has actually seen a very strong improvement. Now, what are some of the critical signs or the signals when we want to look out for a meaningful recovery or rebound in the Chinese market? It's a couple of things, which I probably will not go through in detail today due to the lack of time, but I will just quickly go through what are some of the indicators you might want to pay attention to. So after today's webinars, you can actually keep a lookout for. Number one is you probably want to take a look at some of the SME businesses trend, right? What are their outlooks and what are they reporting, right? The surveys, the indices of these SME businesses, because more than 90% of China's GDP is driven by small and medium enterprises. The next thing you should probably want to look at is the overall unemployment rate in China. So you probably want to track that as well, because that determines how the economy has been growing. Third is to look at the PBOC's continued monetary support. So this is a very critical signal, because as the Chinese government steps up its easing policy, it's really a sign that that is the turning point where the Chinese economy is starting to recover. And again, this is what we are also seeing in the US back in 2011, 2012, where you have very aggressive quantitative easing policies, which has really led to a long bull run, in the next over the 10, 15 years, which we have seen. Sorry, over the last 10 to 15 years, which we have seen. Fourth, we want to be looking at a change in regulation stance, change in policy regulation stance, meaning talking about how the property sector are loosening in terms of their regulation. That's also very important to actually take a look for. Already, we are seeing the Chinese government starting to relax a lot of policies. For example, they are reducing the amount of down payment home buyers can actually make to purchase a property. Previously, it was actually much harder. They actually increased that down payment requirement, but now they have reduced that down payment requirement by less than 20%. right? So it makes it easier for home buyers in China to actually buy or purchase property. So it differs from different governments, from different local governments. Each government in China or each province, each state have their own property measures. But by and large, the direction of how this regulation stands, is met out by the central government, by the CCP, right? So when the CCP says that property regulations can be loosened, then you start to see a trickle-down effect across all the different local governments. So this is something which we have to pay attention to. Lastly, of course, is consumption spending. So by looking at different businesses, looking at companies, one example which I shared with you was Alibaba. You can see how its revenues have actually improved, and that's a very, very important point. Another thing to be looking out for are companies as well, global companies, US companies, which have a big presence in China, and whether they are exiting from the market or actually putting in more money to grow their presence in China. So consumption spending is very important to actually track, because going forward, the Chinese economic growth will be driven more from consumption spending. So we are looking at the middle income group of spending. So purchasing power must continue to increase in China in order for the economy to benefit. That's very important. And one big example in consumption spending is also to be looking at the recent Golden Week, which has already happened this week. You can see that this came out a couple of days ago, and you see that China tourism revenue has more than doubled over the holiday weekend. Again, this was something which I shared with my community in the previous private webinar, which I have last month, where I spoke about how the travel bookings in China has increased by more than 20 times compared to last year, when China was still in a zero-COVID lockdown mode. So I've also spoke about how the reopening of China's economy will really set a tone going forward in building up the economy again, right? Even though we might not see that happening immediately, but over the next quarter will be mission critical to note when we are looking at some of this data, right? You can see that China has spoke about how the sales has more than doubled since last year. Domestic tourist trips locally has reached close to 400 million. So people are actually have the spending power, who want to spend, and they are ready to spend. So this is going to benefit a lot of businesses, a lot of companies, right? And it's not something which, for me as an investor, I would blatantly say it out. No, it's not, because if you see from the different companies, all this spending has also been trickled down into some of their latest financial reports. So have a closer look into understanding some of these financial statements, right? So these are some of the important points which I want to really drive across for today's webinar, right? I've shared with you the three big points here, right? Talking about the properties, talking about the property sell-off, what's the current situation, the problems, addressing the issue about consumption spending, where it's not entirely true, because if you see on the ground, companies are still spending, they're still investing capital into the economy. We're also talking, number three, about how there's a divergence in policies, from the Fed increasing interest rates and China easing. Then, of course, sharing with you some of what are the concrete signals which we have to look out for, especially over the next quarter, over the next 60 days, because this will be mission critical when we're talking about a recovery, a potential recovery in the Chinese market, and how we have to be positioned as investors, especially when investing in the Hong Kong market. Of course, right now, I'd like to spend the rest of the webinar to share with you some of these ideas which you can potentially be looking at. And one of them is actually Alibaba. You can see that a lot of people have been asking me about Alibaba, my readers, my members, talking about China's internet stocks. And what I would say is that the Chinese internet stocks, whether you're looking at Tencent, JD.com, Meituan, PDD, even for Baba right now, they are really trading at very, very good value. So as long as that their price to earnings is in a reasonable range between 12 times to 15 times price to earnings ratio, I think that there's actually good value in this time of the market here. In fact, for Alibaba now sells at a 9 times price to earnings if you compare to the S&P 500 of 23 times. So if you see Baba, I'm comparing the US listing, the ADRs. So it's at a single digit price to earnings. And you can see how it has actually traded in line with the Chinese stock market, how the sell-off has affected the Chinese ADRs, especially for Alibaba as well. And while the S&P 500 is trading at a slightly higher valuation, Alibaba actually offers a much more affordable bargain kind of valuation here. If you see here, Alibaba, excuse me, its revenues have actually increased by more than 14% compared to the last year. Net profits have grown close to 50% as compared to the last year, really driven, as I showed you earlier, that it was primarily driven by higher revenues from its e-commerce business, domestic e-commerce business, again, reflecting the healthy consumption spending in China. And you see its earnings per share has also grown close to 50%. This also measures the profitability of the business. So I don't have to be looking at too many details here. Pay attention to some of these key indicators, and that will give you a very strong signal of whether not only the business is doing well or not, but also whether the general economy is doing well or not, right? A lot of times, these companies can send out very subtle hints on how the macro environment is, right? As we can see from experience in some of our Singapore stocks, by looking at some of these Singapore businesses, we can also know whether some of the sectors are doing well or not, right? In China, it's also the same thing, right? So I'd like to point out again, right, how the revenues have actually grown very healthily over based on the previous financial quarter. Of course, going forward, there might be some uncertainties. There might be changes. There might be more investments going forward for Alibaba as they try to invest into the business. Because if you look at where the business direction is going over the last couple of years, right, Alibaba has been focusing on trying to grow its users and trying to retain its users. So it's a lot like our platforms, like Grab, for example, like Uber, right, where they have transport platforms, social media platforms like Facebook, even for Alphabet as well, where they have their own YouTube platforms. A lot of these internet companies, they always try to focus on user retention first, and you see how Alibaba has successfully grown to more than 1 billion over any annual active users globally. And out of this 1.3 billion consumers globally, 1 billion is actually coming from China. So they have already sustained or managed to retain a large amount of users on their platform. That's what they have been doing, what they have been investing over the last couple of years. That's why they have been pouring a lot of capex into the business. Perhaps that's why we might not be seeing very meaningful cash flow, free cash flow. But now that they're slowing down this user retention because they have probably hit saturation point, then they're trying to do cross-selling opportunities, right? So that's where they start to see all the different business units trying to cross-sell into different segments, into different platforms. So this is very important to take note. Alibaba is right now at a transitional period of moving from huge user growth to more trying to cross-sell on their platforms and trying to increase the profitability coming from each of their customers. So it's a lot like what Netflix is doing as well, a lot like what Meta Platforms is doing with Facebook too, right? And this is really the inflection point again. And you would see that not only that, Alibaba is also trying to speed up its business, which is a telltale sign of, number one, trying to work with the Chinese government to better understand what Alibaba is. So the Chinese government doesn't want to destroy Alibaba. It's definitely not going to do it, because if you travel to Hong Kong, if you travel to China, you will realize that a lot of the payment systems have to use either your WeChat, which is owned by Tencent, or Alipay, which is owned by Alibaba. Right? The Chinese government wouldn't anyhow use payment systems unless they trust the companies. Don't forget that China is very strict on their security, data security issues, right? And they're very sensitive to this. And in order for Alibaba to even allow to use Alipay, right, sends a signal that the Chinese government actually, beneath the hood, that they actually want to work with Alibaba. Right? It's just that they need to have some regulatory oversight. So listing or breaking up its business and trying to list it or IPO it in the market itself is actually a signal sent to the Chinese regulators, saying that Alibaba is willing to actually work with the Chinese government. So this would also be a big tailwind or big strong point as Alibaba tries to monetize some of these business assets. Now, one thing which I want to talk about Alibaba is actually, apart from its listing, apart from its recent strong growth in its e-commerce platform, actually the biggest potential or the biggest tailwind is actually coming from its cloud business. So its cloud business currently takes up the smallest proportion of its revenues and profit, but it's also growing the fastest. Um, China's cloud sector is right now worth about 200 billion yuan. But it's projected that this cloud sector will actually grow to about close to more than 1.2 trillion yuan in the future. So the amount of addressable market in the cloud segment. So you're talking about businesses using or storing data. As we can see in the US, even in Singapore, there are a lot of data storage businesses, cloud softwares, and as more and more individuals, more and more people, companies moving into cloud, the need or the demand for cloud from enterprises, from businesses, from individuals will increase. Personally, myself, for me, I subscribe to cloud services. I pay for cloud subscription because I need the data storage. There'll be lesser and lesser people putting data in your physical hard disk, and more people trying to put their data into online data storage softwares and storage devices. So Alibaba Cloud is going to be one of the big drivers. In fact, Cloud Intelligence Group, which is owned by Alibaba, is now the world's third largest and Asia Pacific's largest cloud computing service provider. This is another big tailwind for Alibaba itself, and that's why a lot of people, even though they have criticized about Alibaba's poor valuation, but what they don't realize is that there is a huge amount of potential coming from this business. And even though there's this huge potential, you don't really need for Alibaba to be trading at 20 times, 30 times price to earnings like your Magnificent Seven or your big tech in the US, which are trading at least 25 times price to earnings. Sometimes from a 9 times price to earnings ratio, which Alibaba has now, it only needs to go like 12 to 15 times to a fair, sort of more fair or sound valuation. Then you can really, achieve or profit from some of these potential investments here. So going forward, consumption names will probably have the biggest upside potential in China's easing policy. So we're looking at China internet businesses. That's something which I like. You look at consumption spending, manufacturing companies, which produces products and services. This will have a very strong effect on markets as well, which will also benefit from China's easing policy, because as China starts to ease or loosen up their policy, it makes it easier for people to start spending again. It makes it easier for companies to start growing again, and this also brings down a trickle-down effect to people on the ground wanting to actually spend more. So the downside probably here, because it's already at its lowest point, is probably about another 10, the most 15% downside here from here. So there, we have to expect some form of volatility. We need to expect how the markets move up and down. So if you can't really accept this kind of risk, then I think I would suggest not to actually look into this market. But if you feel that the short-term volatility is something which you're willing to accept, then I would say that I think that there are plenty of opportunities to be looking at, especially for Chinese internet. They will react very positively to consumption-related news. This is something which will be a very strong signal to be sent out, right? So Alibaba is one of the big highlights which I like to share about here. Now, there are actually more things which I talk about. There are actually a lot of very interesting ideas about, I'm not going to spend too much time in this very short webinar. There are a lot of interesting insights which I've also shared with my community, and maybe I just would like to also share with you. Maybe you can also start to follow our community, because I just want to give a little nudge that we are also going to launch our diligence membership again for this week, and exclusively only for this week. This is where I'm going to share, where you'll get to see some of my potential stock ideas, where I have already split up into 4 big stock categories across value, income, growth, and tactical. So a lot of what I've shared earlier on is really on the surface. I've gone deeper down with sharing some of these information, these insights with my members, also sharing a bit more about some of the interesting names and sectors which we are also seeing. So sometimes, right, the hard investments, I would say, is the right investment. And the reason why is because when you're looking at all the sell-off here, when you're looking at people, moving away, it makes sense to be contrarian here. Not for the sake of being contrarian, but you want to see where the sheer outrageous value really lies. So say, for example, I did share earlier this year, a couple of months back, say, for example, looking at Adobe, right? It has fell from close to $600 per share. At one point, it was about $300+. So it was also one of the hardest trades or investments to be making because the shares have actually fell almost or more than 40-50%, right? It's fell more than half, and it is also very scary, right? But if you take a deeper look into what's really going on in the business, fundamental is still intact. The business is still intact. So I shared this idea, first shared this idea early in April. We bought this in May this year, and we were up about 30% since April 2023, right? So this is one interesting name which we have seen. Another one is also Domino's Pizza. And again, right, one of the hard, very tricky investments or hard investments to make is also Domino's Pizza. I was initially also pushed back with some resistance as well. And some members, they were quite skeptical about it because you see how shares have actually fallen from about over $500 per share and hit close to a bottom about $300+ per share. But interestingly, we also picked this up. Again, if you look at the fundamentals, it has been growing very well. If you look, these are not your big tech companies which we see, like your Alphabet, Apple, Netflix, Microsoft, Intel. These are basically consumer-related businesses where they have some form of strong branding power, strong moat, right? So we don't just want to pay attention to the macro environment, but what we want to pay attention to is from the bottom-up approach, which I have been using this fundamental approach to investing for the last decade here, really to focus on where these strong ideas are coming from. So in just 3 months, we were up about more than 17% for Domino's Pizza. It was actually much higher, but because of the US volatility, the stock has sort of traded slightly down. But again, right, these are all very interesting technical opportunities which we can be looking at. And that's why, right, if you look at investing, we don't just want to look at just one market alone, right? The opportunities is boundless when we look across the global markets. This is something which I've said this repeatedly over and over again, even when I was on radio doing an interview, even when I was doing a conference earlier this year, where I spoke about building a global portfolio. It is very important. And the reason why, again, if you see, right, different markets, they behave differently in certain periods. You can see here for legendary Jeremy Grantham, right? He did talk about how the S&P right now is trading close to its peak, and it could actually crash by over 30% and also fall by another half if, let's say, things don't go well. So in the US, you are also facing certain risk which you might want to be careful of, especially if you're investing in big technology companies. On the other hand, sometimes when you are looking at bargain opportunities, your downside risk is actually much lower than compared to the big markets which everyone is actually looking at, right? So we have to understand this very nuanced point when it comes to investing. We don't just want to invest in just one market, but also split across all the different markets as well. So when you follow us in our community, of course, you get access to my full diligence stock watch list. So this is the full watch list where I share my potential ideas, which I might be buying over the next month. This includes the right price limit, my intrinsic value calculations, my risk rating as well. So that means telling you what sort of positioning which you need to actually look out for. For example, I make a risk rating change to one of the Singapore REITs, which I shared with my community member last month. And this is after actually having spoken to management themselves. This was one of my concerns. So unlike many of the memberships out there where they only keep adding on ideas, I do track a lot of this. We do track and monitor a lot of these ideas. And because I come from the school of fundamental investing, it's important for me to understand that if fundamentals change, I wouldn't hesitate to cut off or cut loss my position, right? So this is actually a very, very important point, right? For me, I'm willing to stick out to tell you, okay, if this particular business is not doing well, it is not going to do well, right? So you get the full picture of what's really going on, right? The good, the bad, the ugly, right? So you get my full diligent stock watch list. Joining my community also gives you access to my personal portfolio. So this is a portfolio which I currently manage for my mom. It's more income focused because she's in retirement. You get access to all my 37 names split across all the different allocations across Singapore, Hong Kong, and the US. So especially if you're starting out investing and you want to learn how to build this portfolio, but you do not know how because there might be too many stocks, it's very overwhelming. It is good to pay. It is good to try to understand and learn how we actually conduct diversification across the different sectors and different countries, right? So this is important, especially if you want to build a sustainable portfolio, especially also, right, if you want to actually build this safely as well, right? So only for this week, again, as I open this up for new joiners, specifically for new joiners, you get a free 3 months subscription. You get my full access to my latest monthly research report. So for this webinar, right, I spoke a lot about China, but I also published my thoughts on what's going on with US macro. And there's one major indicator which I've mentioned in my research report that investors need to look out for, and it's not about the stock market, right? The bubble is not in the stock market, but it's really in the US property market. And there's one indicator which I want to share. I can't share it with you today because due to a lack of time, but you'll get more information based on my latest access to my research report and also the latest ideas which I've also been talking about as well. Each month you'll be talking. I will share with you 2 potential stock ideas for the month which I'm potentially buying. Again, the access to the full stock watch list, and every month you have the access to my live webinar where I'll give you the breakdown of the macro updates, my ideas, and my portfolio ideas as well. If you're looking at building a portfolio as a beginner, I've also came up with an insider's guide on how to build your portfolio as well. So this has been very useful, especially when you come aboard. You'll get a special bonus, which is my one-on-one private coaching program. This is where you sit with me one-on-one. I've done this before with some of my consulting clients, which they've paid me anywhere between $5,000 to $10,000. But this is inclusive of the community membership program. This is where I help you to sort of get started building a portfolio for you. Whether you need to build a portfolio or whether you need to actually repair or fix up your portfolio, this will be very, very helpful as well. So joining me, if you are not happy or if you feel that this is not for you, there's always this 30 days risk-free guarantee, right? So for me, for this webinar, while I've actually shared with you what's really going on in the Chinese market, and I don't think that China will be on the verge of collapse. If you'd like to know more about what me and my community members are currently doing, try to uncover some of these stock ideas which could be worth thousands, tens of thousands of dollars in profits, and at the same time, more importantly, to cut down your research by more than 90%, saving you the time on complex analysis and leaving most of the fundamental analysis to myself and my team. This is something which you might want to actually consider. The launch will come this coming Monday on 9 October, so you'll receive this in your email. Do keep a lookout if you're interested. So I will just leave you off with one final word here before you guys enjoy for the rest of the weekend, is that, I just like to say that we might not be the smartest in the room, we might not be the first in the room, but what we can potentially outperform in terms on a consistent basis against other professional investors, other institutional investors, is that as long as we have patience, right, being able to have that long-term outlook, I think we will be able to definitely profit not just from a bull market, but also from a bear market. Right. With that, thank you so much for joining this webinar. I hope you've enjoyed your time. I'm going to start taking on some questions. Let me see what time is it now. Yes, so I've ended sharply 11 a.m. So I'm going to spend a couple of minutes to answer some Q&A. So if you have any questions, feel free to type in the chat box below and I'll quickly answer this. All right.
Let me check her.
Okay.
How do I get back to you?
From Angeli, any risk we need to be aware of for diverging policies in China versus global markets? So there are definitely a lot of risk when we look into markets, not just in Singapore, not just in US, China also. There are also some risks. Number one is when we see a reversion of China's monetary policy. That means for China, rather than going into a full-out stimulus measure, they start to retreat or start to tighten their policy. So I don't think that will be a very high probability, even though that could be a possibility in slowing down the easing policy, because that would mean that they are trying to restrict or regulate certain sectors or certain industries. So if you look at China, right, what they're really doing, right, by easing policies, they're also weakening the yuan. That's why you see the Chinese yuan depreciating against the Singapore dollar, against the US dollar. And the reason why is because China at the end of the day is still largely an export-oriented economy. And in this world, right, economies are moving towards more export-oriented products and services. That means countries, they're trying to do more of these export-oriented flows in order to grow the economy. And China is still one of them. In fact, China is still the manufacturing powerhouse of the world, and it's very difficult to escape from that. One of the companies which I spoke to in Hong Kong said something which have left me very memorable, and this was also the reason why I am still very much bullish in China, in Hong Kong. And what they said was this, that even though a lot of companies are moving out their manufacturing hubs, their factories from China into places like Vietnam and South America, it's impossible to ignore, again, China, largely because if you move all these factories out, the companies, right, the cost is actually going to go higher because China has the full supply chain in the country itself. On top of that, right, there's nowhere else in the world where you have 1.4 billion people, 1.4 billion very hardworking people who are willing to actually work, the full day round the clock in building the capacity. There's really nowhere else in the world you can actually do that. So that's something which actually got me really thinking about China is really a complete supply chain. And on top of that, there's nowhere else in terms of manufacturing where you're actually seeing the intellectual capabilities and intellectual firepower on some of these high intellectual manufacturing goods, right? The lower end, you can probably outsource the lower end manufacturing to other countries, but it's very hard to ignore China. So that's why you see, right, when it comes to policy risk, the tightening of interest rates could be one risk where it could actually send the stock market nosediving again. Although I don't see that as a very high probability. Okay, so the percentage of small businesses in China, right, more than 90%, in fact, it's closer to 95, 96% of GDP is driven by small, medium enterprises in China.
对，9月的，你先还一次钱，就是他现在这笔他transfer进去。
Okay, from Sahid, what would be a potential growing ETF to buy with exposure in Hong Kong and China? So for me, I don't really look into ETFs, at least not for now. But one interesting ETF you could look at is the KWEB, the QUIT ETF. So that actually represents exposure to Hong Kong China technology for one. But for me, I tend to go for individual stock picking. I feel that I have a better edge in looking at some of the fundamentals, because when you're looking at ETF, inevitably you might be diversifying your exposure to different companies, but it's very hard to see what are some of these profitable companies. Again, right, technology companies, not a lot of them are profitable, as we have seen in the US and how it has wrecked, has a disastrous effect on the economy by investing into very high growth companies, very high growth technology companies. Not a lot of them, they make money, so we have to be very careful about it, especially investing in ETF. Okay, I'll try to answer most of the China-Hong Kong questions first. Then, if there are any questions for Singapore and US, if you have time, I'll try to address them. I'll try to stick to the topic for today's webinar. Okay, so what's my top 3 China stocks for dividends? I like the Chinese banks. Definitely, I like the Chinese banks. That's actually one of them. That actually constitute a large portion of my top picks. I also like the REITs in Hong Kong as well. That also constitutes, so China stocks also includes Hong Kong stocks as well. I like the REITs as well. So these are also very interesting dividends, and they are ranging anywhere between 6 to 9%. You can be looking at ICBC. Okay, out of the 4 Chinese banks, I like ICBC, China Construction Bank, and Bank of China. I don't really like Agricultural Bank of China, and primarily the reason why is because they have loans in agriculture, and agricultural loans tend to have a much higher non-performing loan percentage. So that's an exposure which I do not like to have. Instead of investing in Chinese stocks directly, can we invest in Singapore stocks such as CapitaLand China Trust that have strong exposure to China? Yes, you can. However, what I would like to caution is a lot of the Singapore companies which invest in overseas market, for example, China, don't really tend to have a very strong edge in the business itself. Because if you realize a lot of our Singapore companies, right, when they move overseas, they tend to face a lot of challenges, a lot of competition. One example is CapitaLand trying to invest in properties in Malaysia and then doing a REIT. So you have a CapitaLand Malaysia REIT, which has not been doing very well. I've seen the fundamentals of the REIT. Malaysia REITs are very, very difficult to manage, primarily because a lot of the retail properties in Malaysia don't have a very strong occupancy rate. That's one. Number two, you have the Malaysian ringgit depreciating against the Singapore dollar. So even though you have a big name like CapitaLand going to Malaysia, it's not generally, I wouldn't generally advise to be looking at those companies. I would be looking at domestic companies who already have an edge. So you can actually do that. For example, CapitaLand China Trust, you probably can do that. But if you see that CapitaLand China Trust, right, they have actually diverted their strategy from retail to logistics. So when companies or REITs, when they do that, right, it shows that they are struggling with the sector which they are very good in. And that can be a big issue, because if, let's say, your competitive edge cannot even survive in China, then if you try to diversify into China logistics, for example, into a different segment, I think the company is going to just get crushed, or it's just going to face very, very deep challenges in the country itself, right? Having said that, right, when you're looking at Singapore companies, you want to be looking at the big ones which are able to diversify themselves and already have a very strong presence in the overseas market. For example, like Ascendus, Mapletree, they do already have that presence for many, many years. CapitaLand China Trust, they only recently built a presence in China. So there's actually this big difference or big distinction. Okay, I hope that helps. With pre-sales property, what's the risk of contagion on banks and consumers? I think the risk, like the US, the risk for financials is actually in the regional banks. So China regional banks are facing a big trouble with all of these property developers, because a lot of their profits and businesses are being lent out to the smaller property developers in China. The safe ones are the big 4 banks. So for me, right, when I invest in China, I want to only stick to the big 4 Chinese banks. The regional banks, I will probably be more careful. US as well, I will probably stick to the US mega banks and really be more careful of the US regional banks. So the risk of contagion will probably be restricted to the regional banks more so than to a widespread financial economy in China. Consumers, not so much as well. In China, consumers have a very high savings rate, and as I've shared with you earlier, the savings rate in China is high, and people tend to generally save more. And you can see that when they spend, overall, right, in China, generally speaking, the savings rate allow them to buffer in terms of the spending, which is very different in the US. The US is probably more indebted, where people spend based on are funded by debt, not so much on savings.